So, what if we could combine the power of government funding, the engine of private investment, and the heart of philanthropy to solve some of the world's biggest problems? Well, that's the whole idea behind blended finance. And today, we're going to break down exactly how it works.
Let's start with a number that's, well, it's almost hard to wrap your head around 4 trillion US dollars. And that's not the total cost for something. Nope. That's the estimated annual funding gap we need to close if we're ever going to hit the UN's Sustainable Development Goals by 2030. It is a truly staggering figure.
And here's the tough reality. We're just not closing that gap anywhere near fast enough. Look, traditional funding from government grants and charity is absolutely vital. But those sources alone, they just don't have the sheer scale to fix the kinds of complex challenges we're facing today.
So, let's talk about this multi-trillion-dollar gap. Understanding the massive scale of this shortfall is really the first step to figuring out how we can possibly fix it. This chart, it really lays out the stark reality of the situation. On the left, you've got that $4 trillion annual gap we're talking about. And that tiny, tiny little bar on the right, that represents the total flow of blended finance. On average, less than $10 billion a year. It is a tiny drop in a massive ocean.
So, you might be asking, why isn't more money just flowing in? Well, the simple answer really comes down to risk versus reward. We can't rely on commercial capital by itself because private investors are, understandably looking for market rate returns. And a lot of these crucial development projects are just seen as way too risky, especially when they're first starting out.
Okay, so if traditional funding isn't enough and commercial capital is hesitant to jump in, how in the world do we bridge this gap? This is where blended finance comes into the picture as a really powerful solution.
So what is it exactly? Well, blended finance is all about strategically combining funding from 3 different wallets. You've got public sources like governments, philanthropic sources like foundations, and then the private sector investors. By bringing them all to the table, blended finance can make projects that were once considered unbankable suddenly look pretty attractive, unlocking huge new pools of capital. Now, the secret ingredient that makes this whole blend work is something called catalytic capital. You can think of it as the brave money. It's patient, it's willing to take on more risk, and it might even accept a lower financial return. Its whole purpose is to be the first one in the door, to de-risk a project just enough to get those bigger, market-rate investors off the sidelines and into the game.
And you know what? This model couldn't be coming at a better time. It lines up perfectly with a big shift that's happening in philanthropy. As this quote points out, especially in places like Asia, donors are moving on from just writing checks. They want strategic collaboration. They want to see measurable impact. Blended finance gives them the perfect way to do just that.
Okay, so we've covered the what and the why. Now let's get into the how. It's time to open up the blended finance toolbox and take a look at the mechanics of how this all actually works on the ground. A really great way to think about this is like planting a community garden. First, you need the land, right? That's your philanthropic or catalytic capital. It's the foundation. Next, you need the seeds. That's the private investment, bringing in the resources for growth. And finally, you need support, things like tools, water, expertise, which is kind of like the public sector funding. You absolutely need all 3 parts to create a garden that really thrives. So beyond the garden analogy, what are the actual financial instruments we find inside this toolbox? Well, the toolbox has a whole range of tools. For instance, instead of a normal loan, you might get something called concessional debt, which comes with a much lower interest rate. Or maybe you'll see asymmetrical equity, which is just a fancy way of saying that the brave money investor agrees to lose their money first if the project doesn't work out, protecting the other investors. See, it's all about using these creative tools to strategically lower the risk and make a project possible. All right, so that's the theory. Let's move from the toolbox to the real world and see how these instruments are actually being put into action. So one of the most common tools you'll see is concessional capital. It's a pretty straightforward idea. It's funding that's offered on better terms than you could ever get from a commercial bank. For example, imagine a sustainable agriculture project getting a loan it can pay back over 20 years instead of just 10. That extra bit of breathing room can be the difference between success and failure.
Now, one of the biggest hurdles in this whole space is something called the pipeline problem. You literally have investors with tons of money, but they struggle to find enough projects that are actually investment ready. This is where technical assistance facilities become absolute game changers, providing that crucial early funding for things like feasibility studies that get a project ready for the big leagues.
A perfect example of this is Conservation International's Natural Climate Solutions Facility. The problem was a real lack of investable projects to protect natural ecosystems in Southeast Asia. The solution? A technical assistance facility designed by Trisector Associates and supported by family offices. It funds the really early stage stuff like project design, de-risking these opportunities, to create a healthy pipeline for larger private investors to jump into. Okay, here's another powerful tool: results-based financing. The idea is simple but pretty revolutionary. Stop paying for just activity and start paying for outcomes. This directly ties the money to measurable results, which makes sure every single dollar is used as effectively as possible.
This often takes the shape of a pay-for-success model, which you can see right here. It starts with an investor putting up the upfront capital. Then, a program is delivered, and its success is measured against very clear, pre-agreed metrics. If and only if those targets are hit, an outcomes funder, like a government or a foundation, repays the original investor. A fantastic example of this in action is the Gates program, which used this exact model to successfully place individuals with autism into high-skilled engineering jobs. And this model can get even more creative. Let's take a look at a really cool variation called the Outcomes Amplifier.
This was used for the AWWA Family Empowerment Program in Singapore. Now, here's how this outcomes amplifier worked. Standard Chartered Bank provided the initial funding to get things going. Then, as the program successfully empowered low-income families and hit its goals, Temasek Trust stepped in as the outcomes funder to finance the next phase of the project. It's such a clever structure that lets successful programs scale up based on proven results.
So as we look back at these examples, from climate solutions to family empowerment, one central theme just keeps popping up: collaboration. This is about so much more than just mixing money together. It's about building a shared vision for lasting good. And that right there is the real power of this. Blended finance creates a structured way for governments, companies, and charities to combine not just their money, but their unique strengths and expertise. Now, it does take specialized organizations like Trisector Associates to put these complex deals together, but when it's done right, they unite everyone on a shared journey to create solutions with real, measurable impact. At the end of the day, blended finance proves that it is possible to unite our very different resources for the common good. It helps us shift our focus from individual efforts to truly powerful collective impact. And that really leaves us with one final and pretty important question. Now that we have this tool, what global challenge should we point it at next?